Let's get the two CEOs talking about what they are seeing in terms of SIPs, domestic flows, also in terms of market value. Bala, people are calling it silver lining, but I would say it's the biggest hurrah that domestic institutional investors are supporting and they're buying in this fall. And SIP investors, they continue to focus on asset allocation rather than taking a myopic view of today, tomorrow, and yesterday and today. What is your understanding, Bala, when you talk to your distributors, when you speak to your investors? Do you think DII support in this market is here? The SIP investors are here. Do you now fear redemptions?
Yeah, I think the way I see Nikunj, the trend is rather the reaction to the market. Definitely, of course, steep fall, what we have been seeing in the last 2 weeks, has created some element of panic for direct equity investors. At the same time, the investors who have been coming through the mutual funds, and we are generally are seeing the query for investing has been rising. And second is SIP as an asset class, or maybe a step up kind of investing, which generally we all encourage, and the market falls. Maybe they should increase the allocation towards mutual fund equity schemes. That's something also we see a positive response coming from both the distribution community as well as the investor community. But having said that, as you all know, as it is known generally, that the large pool of money has also been coming to the equity market by way of direct participation. They also seem to be realizing the fact that I think investing into the mutual funds could be a better idea. As you rightly put it, asset allocation ultimately is the one key to the success. From the broader perspective, definitely the fall is not being seen as as something one should take away the money, and definitely is being seen as something one should actually allocate into equity from longer term point of view. Given the fact historically, whenever such a steep fall happens on the fear of war, whether it is World War One, Two, or any type of war you take historically, and the market has only a bounce back post that after seeing such a sharp fall, and that's something also is now being recognized and realized by the investors base and community and the distribution community, and push actually for the investment.
Sunil, they say you should never waste a crisis, but the problem is that we don't know how this crisis will prolong. If this crisis or the shock prolongs for another 2 or 3 weeks, then markets could be sharply lower than where they are. So, what is the best way out? Keep the faith, be a long term believer, or it's now time to genuinely start thinking differently?
No, see, I would say that I think Bala just mentioned, right? Crises have always been the best buying opportunities. And in fact, if you look at it since the Sensex start, there are, according to us, just 40 days have accounted for 80% of the return. That is, those 40 buying days, the steep correction days. So to me, a longer term investor, I don't think he should at all panic or change his methodology of looking at the market, which is that market always goes through a greed fear combination. And when they are greedy, if you are not greedy, and when they are fearful, if you are greedy, that's the best way to get money made in the market. So a crisis like this, let's say, like you say, that it lasts for 2 or 3 more weeks, and the markets could very well end lower. But neither you nor I know that, because all it needs is one agreement between Ukraine and Russia, and they'll say, okay, we whatever, surrender or do whatever, it could go away. So you can never time a market bottom, right? So granted that there is a probability that the markets could be lower a few weeks from now. What do you do today? Do you buy or not buy? My sense is that you got to buy. But the point is you don't put all your money in at this time. You stagger it. Once you stagger it, you're buying it because then you're taking away the uncertainty of how long this crisis will last. So the crisis being an opportunity, it's always a U-shaped opportunity, not a V-shaped opportunity that you have to buy today, otherwise you miss the boat. No. With a U-shaped things, you can buy anywhere along the bottom. Granted, you may not get the best possible, but whatever you get, when you're buying from the bottom, you're only talking about whether you're going to double your money or triple your money over the medium term, right? The buying levels don't matter as long as you're buying in a time when there is fear. And that is classically the case today, because liquidity tends to react to news flows and expected news flows. So liquidity is naturally reacting negatively. So prices are falling. But has any of this crisis altered any of the fundamental dynamics of the Indian economy? I would say not. Yes, short-term commodity-related prices on margins of Indian producers is going to be there. And that impact is again going to be on whether demand in India is going to revive or not. And there I would say that leave alone Ukraine, leave alone everything else. I would say that the domestic consumer is not going to not buy because of the Ukrainian crisis, right? They are going to go and consume. And to me, two successive summers of COVID-related impact on consumption means that to me there is a strong probability of a bounce back in domestic consumption starting this summer. And when consumption rises, when demand is exceeding supply, is when price increase can be passed on. So today, because your demand has not yet risen, you are looking at the pressure and the earnings results are showing that margin pressure, and you are saying, oh, EPS is going to go down, current valuations, are they acceptable, and all of that. But the situation could change very dramatically because ultimately Indian economy, right, to a large extent is self-oriented. It's inwardly oriented, and a lot of the pent-up demand, when it plays out, you will find that the impact of the commodity prices on producers can be lessened. So to that extent, strong companies will ride through this crisis. And because of the fear psychosis, big quality banks and institutions are falling
Yeah.
today, it's an excellent opportunity to buy them. The point is, you have to stagger it because you cannot predict how external forces are going to react over the next 2 to 3 weeks. So my recommendation is, if you have liquidity in your hand, put it into the market. If you have an SIP running, I'll say double the installment for the next 6 months.
Right. Correct. Okay. So that's your strategy as far as the markets go. I'd like to just go back to Mr. A. Bala. Mr. A. Bala, a lot of our viewers who will be watching the screens right now, the last 2 years, they've of course been gotten used to the markets only headed one way, which is up. But when they will see this, they will get scared, right? Sensex down 1600. You've got the Nifty giving up on 16,000. You've got stocks like ICICI, Maruti falling 5%. Oil, at levels not seen since 2008. How to cut out all of this noise? What should be the strategy?
I think clearly, if you see I think you took some of the names where the price corrections have been quite sharp. I think it's large on the back of the bull liquidation, which I can probably call it, or maybe a significant sell-off that has come from most investors, which is not something very small. I think we have seen close to about $14 billion kind of outflow that has happened from FIIs, and continue to be a large seller even a single day when they sell close to about $1 billion size. And the market, of course, is getting absorbed, absolutely no doubt. But having said that, a significant liquidation coming from FIIs, and the banking as a sector is almost have about 35% of the index side, and therefore now they are taking the Brent. And definitely one thing which is happening as a result of that, one, whatever the concern one would have had in the Indian market, having been the significant outperformer to the global market in the last 1 year, that is getting corrected. Valuation, which otherwise would have argued that Indian market is trading at a premium to the longer term valuation, also getting corrected. At the same time, as Sunil mentioned about, from India point of view, while of course we are very well on the economic recovery path, and commodity prices rising, it in some sense, we being one of the resource generator, it helps in some of the companies. At the same time, it also has put pressure on inflation, mainly because of the oil price going up, would have an impact on Indian from the broader economic point of view. But having seen these things, definitely the market correction has been quite sharp, and therefore it makes sense to look at the broader market itself rather than looking at any specific sectors. And having seen, I think banking sector is quite sharply correcting, and that also something that fundamentally everything remains very, very strong. Therefore, one should also look at that as a sector from an investment angle. But definitely the strategy should be to, one, consider this fall as an opportunity. Second is make stagger your investment over a period of next 1 or 2 months. And third, have your conviction that this current war probably may not too long. At the same time, significant price increase that you have seen also can correct as sharp as they have risen recently once that settle down. For one cannot wait for that timing to happen for one to consider the investment.
Subramaniam, does it merit at a time like this to have a higher allocation perhaps to large caps in your mutual funds?
On the contrary, I would say this is a time, I think Bala also referred to this, to broad base. Because see, what is the reason that Bala and I are talking about this being a good time to invest? It's essentially domestic economy, right? Which has suffered the COVID pangs, which had suffered even prior to COVID from the financial crisis and negative inflation, which we saw early 2018, right? The Indian economy is poised to recover. So the way forward, if the Indian economy recovers, is clearly that you would find mid and small caps, right? As a company earnings would beat expectations better than large caps. Large caps have benefited from the FII flows and from that tendency of FIS to prefer safety in a growth economy. And the correction is naturally affecting large caps. So you are saying that large caps have corrected so much, so should I buy? And I would argue no, because when will large caps rise again to the same extent is when FIIs again turn greedy about India, right? Which is some way off given the situation that's happening in the advanced countries. But domestic flows and domestic mutual fund, domestic institutional investors have got a close linkage to domestic economy and EPS growth, which is domestic demand, domestic capex, domestic infrastructure led. So that is a play which is a much broader play than a pure large cap play. So I would argue that, and that's the reason, you mentioned earlier, I think either Nikunj or you mentioned, I don't remember who, that the fall which has happened, right? The FIIs are selling what they considered as their darlings, right? Because of the allocation within the index. But the quantum of their selling, why are DIs not able to match that rupee for rupee? Because of the fact that they are buying that which makes sense to them. So just because a particular big bank has fallen so much, it doesn't mean they jump in to buy that because in the bounce back. So all the selling of the FII is not getting absorbed by DIIs, stock for stock or dollar for rupee, but DIs are taking this SIP money and the flows and allocating in a broader market. So I would say that investors should also take the cue from that and say that ultimately the future of the Indian stock market in the broader space is from domestic economy, and hence I would argue for increasing allocations to a broader multi-cap space as opposed to just saying so many large caps have fallen, so I go and buy those because they're trading at so much of their 50-week or whatever 100-week lows.
Sure. Bala, I mean, I know we're all equity beasts, so it may not be a fair question to ask. While the multi-cap category and a larger allocation to the broader markets aside, the one space which has not given you returns and which investors have completely shied away from has been the debt category. Has the time now to come perhaps to have a balanced approach in your portfolio and maybe some allocation to debt too, or not quite?
No, I think it makes sense to look at shares the hybrid funds. Definitely the hybrid funds which has got a mix of equity and fixed income, which are like a balanced advantage fund or even the balance fund itself could potentially act as one of the alternate for investors to capture the moments in both equity as well as on debt. But having said that, there are many conservative investors who do not want any equity exposure. At the same time, are happy with safety and liquidity. And even if the return is marginally lower compared to any other instruments, definitely with the 10-year bond is now coming close to about 6.8. And probably we are in a rate cycle which could potentially start rising in the next, say, few months, given the fact that inflation is very, very high. Beyond a point, the Reserve Bank of India or even the central banks globally cannot ignore the rising prices from a monetary action point of view. I think once we start seeing some hike in interest rates, definitely the bond market also will provide an opportunity for investors to look at temporarily as an alternate investment to any other asset class that we have. But it is actually, of course, applicable for the people who are conservative, who have reasonably good exposure to equity, now looking for a balance in their portfolio. For them, it makes sense. But otherwise, somebody does not have exposure to equity or maybe have gone about investing in direct equity, thinking that they will be able to make more money by themselves investing in the market directly. Such investors should look at actually the mutual fund diversified equity portfolios, whether it is large cap, multi cap, or flexi cap, even small cap for that matter, from the overall asset gain point of view. Definitely, debt makes sense for those who are overweight and looking for balance in the portfolio. And now it's providing an opportunity given the fact the bond yields are pretty higher than the earnings yield of the market itself.
I'm going to ask, since you're quoting Aisha here, an equity beast, and therefore might be unfair, this question as well, Mr. Bala. And that is it, just with what we're seeing in commodities, right? Isn't this a good time for our viewers to also consider putting cash into commodities, even if it's at the cost of equities?
I think it's difficult to say, given the fact that the rise in prices in metals is quite sharp. I think if you look at the last 1 week rise in prices in, say, nickel or in other commodities, very, very sharp. I think this is largely one because of the supply constraints and the uncertainty that's surrounding the world. And third, of course, not much of supply has been created while the demand continues to remain muted. And this actually, I would probably assume it is not the right time to look at commodities as a space, though it could potentially rise in the short term. With the oil now coming close to about $140, it will not be a bad idea to look. It will not be a good idea to look at commodities as an opportunity. When somebody has made investment, is fine. Companies will make money, absolutely no issues. But from the investor's point of view, absolutely no, I would say.
Okay. It's been absolutely great having both of you here, Mr. Bala as well as Mr. Subramaniam, to try and help us understand what's happening in the markets. It's, a sea of red, unless, of course, you look at the energy prices. It is the energy shock which is taking the markets down with it. The rupee also hitting its lowest multi-year levels, crossing 76 to the dollar.